Somewhere right now, your money is sitting in a bank account earning exactly nothing. 0%. Not 1 cent of interest. And yet that same bank, the one paying you nothing, is on track to make billions of dollars this year. If your money isn't earning them interest payments to you, where exactly is all that profit coming from? The honest answer is that your free checking account was never free. You've just never been shown the receipt. Let's start with something that sounds almost too simple to be true. When you deposit $1,000 into your checking account, that money doesn't sit quietly in a vault with your name on it, wrapped in a little bow, waiting for you to come back. Within days, sometimes hours, most of it is already out the door, loaned to someone else, invested somewhere else, working for the bank. You gave the bank an interest-free loan, and the bank turned around and lent that same money to a business owner at 7%, or used it to buy a government bond paying 5%. That gap between what the bank pays you and what the bank earns on your money is called the net interest margin, and it is the oldest trick in banking. It's also, believe it or not, only the beginning of the story. Because here's the part most people never think about. Banks don't just make money off your deposits. They make money off your behavior. Every swipe of your debit card, every overdraft, every wire transfer, every convenience fee tucked into the fine print of an account you opened without reading a single page, that's a second, third, and fourth revenue stream running quietly underneath the one you already know about. Take interchange fees. Every time you tap your card at a coffee shop, the merchant doesn't keep all your money. A small slice, usually between 1 and 3%, gets carved off and split between the payment network and your bank. It sounds tiny. $1.50 on a $50 grocery run. Barely enough to notice, let alone complain about. But multiply that by the roughly 11 billion debit and credit card transactions processed every single month in the United States alone, and you start to see a river of small numbers turning into an ocean. JP Morgan Chase alone processes trillions of dollars in card volume every year, and interchange revenue contributes billions to its bottom line. You paid nothing extra at checkout. The merchant absorbed the cost. But somewhere in that chain, your bank got paid and you didn't even notice. Then there's the fee that banks genuinely love to talk about as little as possible, the overdraft fee. It looks like a punishment, and in a way it is, but it's also one of the most profitable products a bank has ever invented. Right up there with the credit card and, historically, the stagecoach robbery. A typical overdraft fee runs around $35. Doesn't sound like much until you realize U.S. banks collectively pulled in over $15 billion in overdraft and related fees in a single recent year. And the uncomfortable truth is that this money isn't evenly spread across all customers. Research from the Consumer Financial Protection Bureau has repeatedly found that a small percentage of account holders, often people already living paycheck to paycheck, generate the overwhelming majority of overdraft revenue. In other words, the bank's zero-interest checking account is quietly subsidized by its most financially stressed customers. That's not a conspiracy theory. That's a business model, laid out in plain daylight in annual reports if you know where to look. But let's step back, because there's an even bigger machine running in the background. One most people have never heard of. It's called fractional reserve lending, and it's the reason banks can turn your single deposit into something far larger. Here's how it works. When you put money in the bank, regulations only require the bank to hold on to a fraction of it. The rest can be lent out. So your $1,000 doesn't just sit there generating interest once. It gets lent to a small business. That business pays a contractor. The contractor deposits the money in another bank. That bank lends most of it out again. Your original $1,000 keeps echoing through the economy, popping up again and again, each time generating a little more interest income for somebody's bank. It's less like a single dollar and more like a dollar with a very active social life. This is not a shady loophole. It's literally how modern banking is designed to work. It's also exactly why banks are so aggressive about getting you to open an account in the first place. Every new depositor isn't just a customer, they're raw material. Now you might be thinking, fine, banks make money on loans, that's obvious, everyone knows that. But here's where it gets genuinely strange. In recent years, the interest banks pay on your checking or savings account has become almost embarrassingly small, often a fraction of 1%. While the interest they charge on credit cards linked to those same accounts can climb past 20%. That spread, sometimes 20 percentage points wide, is one of the widest profit margins in modern consumer finance. Imagine a store that buys a product for $1 and sells it for $20, and nobody calls the police. That's roughly the economics of a checking account paired with a credit card at the same institution. So why do you put up with it? Why does anyone accept an account that pays nothing? This is where psychology quietly takes over from arithmetic. Banks have spent decades studying something behavioral economists call inertia, our very human tendency to stick with whatever we already have, even when a better deal is sitting one click away. Switching banks feels like a hassle. You'd have to update your direct deposit, move your automatic bill payments, remember every subscription linked to your old debit card, and relive the mild trauma of setting up online banking passwords all over again. Banks know this. They're counting on it. Studies have found that the average person keeps the same primary checking account for well over a decade. Some estimates put it closer to 17 years, which in financial terms is roughly a lifetime, and in relationship terms is longer than most marriages. A bank doesn't need to pay you interest to keep your loyalty. It just needs to make leaving annoying enough that you never bother. And it doesn't stop at psychology. Banks have gotten remarkably good at cross-selling, which is a polite way of saying they use your free checking account as a gateway to sell you more profitable products later. You open a checking account. 6 months later, an app notification suggests a credit card. A year later, it's a personal loan or a mortgage pre-approval or an investment account. Each of those products carries its own fees, its own interest spread, its own commission. Your zero-interest checking account isn't really the product. It's the storefront window, designed to get you inside the store, much like a candle display at the entrance of a shop you only came into for milk. There's also a quieter, more technical income stream that almost nobody outside banking circles ever hears about. The float. When you write a check or when a payment is processing, there's a window of time where the money has technically left your account but hasn't yet been credited anywhere else. During that gap, sometimes hours, sometimes days, the bank can invest that money, however briefly, and pocket the return. It sounds almost too small to matter, a few hours here and there. But across millions of transactions happening every single day, those slivers of time add up to real, measurable profit. It's a bit like a casino making money not from any single hand of blackjack, but from the sheer volume of hands played every night, minus the free drinks. Of course, none of this means banking is some evil scheme. It's simply a business, and like any business, it has real costs that most customers never see. Maintaining thousands of physical branches isn't cheap. Neither is the cybersecurity infrastructure needed to stop hackers from draining accounts, or the regulatory compliance teams required to satisfy federal examiners, or the fraud department that has to eat the cost every time someone's card gets cloned at a gas station pump. A large bank can spend hundreds of millions of dollars a year just on regulatory compliance alone. So while it's easy to imagine executives cackling over stacks of overdraft fees like cartoon villains, the reality is messier. Banks are simultaneously squeezing profit out of your inattention and quietly absorbing enormous operational costs just to keep the lights on and stay one step ahead of regulators. That balancing act occasionally goes badly wrong, and when it does, the consequences ripple far beyond a single institution. In 2023, Silicon Valley Bank collapsed in less than 48 hours, not because it was lending recklessly to bad borrowers, but because it had parked huge amounts of customer deposits into long-term bonds that lost value as interest rates rose. When depositors got nervous and tried to pull their money out all at once, the bank simply didn't have enough liquid cash on hand to cover it. It's a sobering reminder that the same system generating billions in quiet profit is also built on a foundation of trust. And trust, once it cracks, can collapse a $100 billion institution before most customers even finish their morning coffee. So where does all of this actually leave you, the person with the zero-interest account sitting in your pocket right now? The picture that emerges isn't really about villains and victims, it's about information. Banks have spent well over a century refining a business model built on small, invisible fees, wide interest spreads, behavioral inertia, and the sheer scale of billions of transactions happening every day. None of it requires tricking you exactly. It just requires you not paying close attention, and most of us, understandably, have better things to do with our time than audit our bank statements line by line. But maybe that's the real twist in this story. The most profitable product your bank sells you isn't a loan or a credit card or even the checking account itself. It's your attention, or rather, the lack of it. Pay attention, and the zero-interest account starts looking less like a favor from your bank and a lot more like the opening move in a much longer, much more profitable game.